Hi everyone. So we're going to be doing a debriefing of task F, which was the valuation task in the Psycha 2021 APC. So just at a high level, we're going to be quickly going through what was given in the pre-release, what was asked on the day, uh, what was required for competence, and then we're going to just debrief two specimen scripts. One will be a candidate that was assessed as competent, and a candidate that was assessed as limited competence. All right, so to kick it off, in the pre-release information, we were given in document 3 that there's the strategic direction to invest in mid-tier private schools as a key growth market, and they've identified a number of investment opportunities, and specifically the Elgin Open School was identified as a possible opportunity. And then at the bottom of page 16, it was clear, there was clear triggers there that you needed to think about the financial operating performance of the Elgin Open School, determine a fair acquisition price for Archegos to acquire the Elgin Open School, and then think of any due diligence matters. So what was required to go in to take from those triggers from a technical point of view was to refresh topics from your ITC CTA knowledge, such as financial statement analysis, broad-based performance evaluation, valuation, mergers, as well as due diligence matters. Should have been a clear link to those technical topics from the triggers at the bottom of page 16 especially. And then just at that point, the likely task that could have been thought about is, possible task asking for the commenting on the performance based on key performance ratios, reviewing the provided valuation calculations, which has become vanilla APC. You provided the calculation, and you have to critically review the calculation. And then because of this trigger with regards to due diligence matters, you could have at that stage expected a task which asked for additional due diligence matters or qualitative factors to consider before one acquires EOS. All right. Then on the day, on document F, we were provided with a valuation for EOS as prepared by EOS shareholders. So that the fact that it was prepared by their shareholders, I think, is also a significant point to pause at, because it just means that the shareholders obviously would want a higher share price, so they are incentivized to display or to show a higher valuation calculation. And the task was to apply your mind to whether the EBITDA valuation is the appropriate method for the EOS acquisition, whether the assumptions underlying the given valuation is reasonable, the derived value, and any other issues related to the acquisition. Okay, so around the methodology, the assumptions that use, which is typically happens with calculations in financial management, because we're taking into account the future, we have to make assumptions about the future, and then the derived value, and then also any other issues related to the acquisition that is deemed relevant. All right. So from this, the expected preparation, that in other words, the preparation that one would have expected candidates to prepare beforehand and to have been armed with when coming to this is the following. The different valuation approaches, of which EBITDA is one, the pros and cons of the different methods, the technical workings of the EBITDA, the fact that you should know upfront, if valuations were triggered, that valuation methods are almost all based on assumptions, which ultimately will need to be probed. And as I said, that trigger related to due diligence would have also hopefully prompted candidates to make to look into the possible due diligence or qualitative factors that should have been considered for the acquisition. So basically, this slide is saying that based on these triggers on the slide, we would have hoped that candidates have prepared the following, and if they've prepared the following, it links quite nicely with what was required on the day. All right, so on the day, before we get to on the day, just the technical workings of the EBITDA, just a quick technical refresh. The full EBITDA consists of getting a sustainable or maintainable EBITDA, which needs to be multiplied by an EBITDA multiple We then need to add surplus cash, if any, and that's because within the EBITDA, we ignore interest income that is non-operational. So surplus cash would have interest that is non-operational that we may need to add back, and then we deduct debt at market value. And just in terms of the steps, you typically gonna, for sustainable EBITDA, you're gonna review the history, adjust for non-recurring items, look if there's a trend, apply a weighted average, and just in general question, what's the appropriate basis for the sustainable EBITDA. Then you need to get a multiple, and typically this falls in the realm of relative valuations. So you're going to need to get a multiple of another company, and make an argument as to which other company would be most reasonable. There could be more than one company, and in that case, you might take an average of the other company's multiples. All right, then you need to make adjustments to the EBITDA, as no two companies are exactly the same. So remember, we're ultimately valuing, in this case, would be valuing EOS, and there's going to be no company exactly similar to EOS. And so whatever company we use as the starting point, we need to make adjustments to that multiple. And typical adjustments is listed versus unlisted, size, growth, specific risk factors, and any known differences in the EBITDA multiple. Then ultimately we get a valuation, an EBITDA valuation, which takes the sustainable EBITDA multiplied by the EBITDA multiple, and then we get an EBITDA valuation, but that doesn't give us equity yet. As said earlier, we still need to add surplus cash if there's any, or make an argument to whether there could be surplus cash and deduct debt at market value, and that gives us equity. All right, so let's look at the calculation that was provided on the day. On the day, we were provided with a calculation, an EBITDA valuation. And what I'm just going to quickly go through now is how would we have probed this calculation. So if we start right at the top, there's a forecast revenue of 18,243, which was determined by taking 451 by learners multiplied by 450, which is the rand value. Now at this point, from an APC point of view, putting on your critical thinking hat, you want to be asking yourself two questions. So you're given a calculation and you want to ask yourself, what bothers me about this calculation from a valuation, from a technical point of view? In other words, the technical workings of an EBITDA valuation, and what bothers me about this calculation from an assumptions point of view. And you actually want to ask those two questions line by line. So if we look at the first line, it's 18,243. That line takes the 451, which is the learners, multiplied by the 450, which is the rands. So I want to ask myself, is there anything wrong technically with taking forecast revenue? No, but from an assumptions point of view, the 451 is a growth in learners of 3%, and we are in a pandemic, and we need to ask ourselves, is that reasonable in the current economic climate? And again, the fee of 450 is an increase of 5%. And again, we need to ask ourselves, in the current economic climate, is an increase of 5% reasonable, especially when one considers that inflation at the time was only 3%. Right, and so then what happens is, from this figure, an EBITDA margin is applied to get to the 3238. And now, nothing wrong with applying an EBITDA margin in itself, but we need to, if you actually do the calculation, you'll find out that that margin is the margin that's applied to the 2019 year, which was pre-pandemic. So we need to ask ourselves the question, is it reasonable to expect a margin similar to what we experienced in the pre-pandemic period? Then from that margin, we take into account a after-tax amount. And the question here is, is that correct? Technically, no. EBITDA by definition is earnings before interest, tax, depreciation, amortization. So doing a forecast EBITDA after tax in your EBITDA calculation is technically incorrect. And then just the other thing, from a methodology point of view, that the EBITDA valuation, in a sense, takes a forecast or an actual. You can use a forecast or an actual, but in a sense, then it assumes that there is a constant growth going into the future, which is, one would question, is that reasonable or reliable in the current economic climate? Perhaps what would be better is to do a DCF, where you have a planning or explicit period, and then do an constant growth or perpetuity. So then also we have this is this EBITDA multiple, which is an historic multiple that is being applied to forecasted figures, and that's not apples to apples. You have to apply an historic multiple to historic figures and forward figures to a forward multiple. So that was technically incorrect as well. And then it's this multiple of 8. And if you go back to the steps in EBITDA valuation, we need to be making adjustments to the EBITDA multiple, and it does not seem that any adjustments have been made for risk, listed versus unlisted, etc., etc. Then after that, we get a valuation, which is fine. Then they add cash and cash equivalents. It's only surplus cash that should be added. So the question there is that all surplus cash? That would be a question. And then there's a shareholder's loan that's deducted. The question there is, well, you can approach it from two levels. The shareholder's loan, there's the higher level question as whether shareholder's loan is really debt because there's no repayment terms. If one looks at the case study. So that's the one question. But if it is debt, it should ideally be at market value, and that was at the book value. And then they seem to have added this additional value from the online model. But we have to remember we're valuing EOS on its own here. That extra online model is something that Archegos will bring to EOS, and it will essentially be a post-acquisition benefit. So in other words, a synergy like when we do mergers. But right now, we're not valuing the combined company, we're just valuing EOS. And so bringing in this extra 1,000 is therefore a post-acquisition benefit, which should not have been there. And then if one wanted to dig deeper on that online model, you'll notice that there's 400 learners in the online model and 451 in the almost traditional model. And is it reasonable that your online learners and your traditional learners is almost equal? Maybe in years to come, but where we are at, one would question if that 400 learners is in any event not too optimistic. All right, then maybe just to end off in this video, in the next video, we'll go through some specimen examples. But to end off here, just to say, so what in a sense will we, what did a competent candidate look like? Well, key to an EBITDA valuation, as you can see, is, let's go back here. Key to an EBITDA valuation is the sustainable EBITDA and the EBITDA multiple. So we would have wanted a competent candidate to have had good probing discussion, identifying of errors around sustainable EBITDA as well as the multiple. So that came through. So good probing interrogation of the EBITDA, which is the rand value, the actual EBITDA, evidence of probing the multiple, and then just coverage of other issues. There could have been a number of other issues. So picking up errors or omissions, strategic factors, questioning the methodology. That in combination with a good interrogation of the EBITDA and the EBITDA multiple would have pushed candidates over the line to a competent grading. All right, so that's it for now in this video. Unfortunately, the time I'm using only allows for 15 minutes, so in the next video I'll be going through 2 specimen examples. All right, cheers everyone.